O'clock. I'll talk a little bit. Wait till 8 o'clock. And thank you. Hey, it's 7:57. We're a couple minutes early. Anyone who has joined us early, this is the Gold Fix, and we're setting up for today. Gold has given us an almost signal and then reversed on dollar weakness. The dollar was a little bit stronger last night. If you look at an hourly chart here, the dollar had creeped higher during the evening after initially dumping, creeped higher, and now is selling off. And gold was at its lowest when the dollar backed off here. I'm sorry, when the dollar rallied to here, and now has turned around. I'm wondering if there is some sort of a buy algo, although I can't be sure. Almost got a sell signal here uh, on the VBS system. It would have been a poor signal. I would not have traded it, but I would have watched it. Um, 7:58. The focus of today is going to be, uh, well, you can get a quick view here. Uh, Yesterday, I tuned in and listened to the whole of Jeff Gundlach's double line presentation, and he's a bond guy, and as such, he will talk about the dollar, which is essentially talking about gold, and he actually did talk about gold directly. There were two takeaways from that I thought were the most important uh, points that he was driving or indirectly driving. Gunlock is looking for confirmation of recession predictions, and he has nothing solid yet. Although he has shown, uh, and this is by his own admission. This is not my opinion. I mean, it is my opinion, but it's basically I'm reiterating what he said. He's seen three or four things that say this could be a recession. It could be a false positive, in several different of his metrics that he uses, and we'll be touching on that as well as his rationale. Not rationale, but he's much more technically based than most people think. Um, we'll touch on his technical rationale for a weaker dollar, and I can tie that to my own uh, more cash flow rationale for a weaker dollar, meaning the end of QT, starting at 8 o'clock, which is in about a minute. The second point that he was trying to make, well, he made very clearly, was he is almost adamant that the US dollar is set up for a drop. What is hard to reconcile at first glance is uh, predicting a recession and then predicting a weaker dollar, especially when commodities are already off their highs. Okay, it's 8 o'clock. We'll start on that now. Good morning. This is Vince Lanci with the Gold Fix, and it is January 9th. Yesterday was um, more of a research day, as I spent a lot of time going through, listening to, and going through Jeff Gundlach's slide presentation for Double Line. A lot of macro investors will tune into Jeff's work and hopefully get a copy of the. I'm looking for those right now. Looking for a copy of the uh, the report. But before we get into that, we'll touch on three things. We'll touch on what's in the news today very quickly. We'll go through the analysis of Gunlock's comments on gold, and by gold indirectly, he talks about the dollar. We won't go through his whole presentation, and we'll go through tradable levels for today. We may have, we almost had a level just now to sell. We did not get one. We'll see what the next hour or so brings. Okay, so the trade talks concluded, if you will, on an optimistic note. The U.S. and China are set to meet, um, even as the government shutdown continues here. Oil rose above $50. Those are the major things that happened yesterday. I wouldn't necessarily call them major, but I think if you're looking at the China trade talks with the U.S., we have said here and on the AM roadmap repeatedly that China is in a stronger position in terms of time as time goes by, and that I believe that to be true because China could just wait out an election. However, uh, the Chinese Lunar New Year starts, and that is the biggest time of year for domestic consumption for them. And their economy really kind of depends on it. Kind of like retailers need Black Friday to go in the black and be profitable for the year in sales. So these trade talks, although they may not be showing it, but the delay hurts them as well. I just don't think that they care as much about their citizenry as we do about ours. It's not to say our politicians care much about ours either. But I'd wager to say that they care a little bit more than the Chinese government cares about theirs, just by virtue of having to be reelected every year. So don't think that China is not feeling pain. Just keep in mind that the Chinese government has no qualms pushing that pain off to their citizenry. I've made the joke many times about a culture that used to eat uh, tree bark. That's no joke. So moving forward from there, so just know this, that the counterpoint to China being stronger on the trade front because they can wait Trump out, and they can, is that there is some domestic pain as the Chinese Lunar New Year starts, and that's generally their biggest domestic consumption. And if they're not making money making stuff for us, and uh, they're not spending money domestically, so okay, so from there we had Trump speaking last night about the border wall and the government shutdown. And those of you who have tuned in here and on the AM Room app, I think for the last 2 months I've been saying that Trump's MO is to create a scapegoat if he can't deliver. And it's been a successful MO through the years that I've watched him as a real estate developer. He did it with Powell, which worked for a while. Before the market dropped, he labeled Powell as a potential reason for the market to drop. That worked very well up until he said he was tariff man. And he really knows he can't deliver on the wall. Okay, he knows it's not easy. So the government shutdown is a redirect for his base to focus and redirect their blame onto the Democrats, because the Democrats are holding the wall hostage by allowing the government to be shut down. Uh, 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 and I'm not blaming Trump for his behavior. I just know the man. I know how the man operates, and when he can't get out, when he sees on the horizon a problem that can't be reconciled, meaning he can't get the money or the labor. I mean, it's hard to build a wall when you have a government freeze on spending and hiring, and that would mean you have to bring troops home. You have to use the U.S. Army Corps of Engineers. Who knows if we have enough, the money, et cetera, et cetera. The statistics that have to be cherry picked. The reality is, once he sees that it's a hard road to hoe, he will start looking for scapegoats and create drama in another area as well. Kind of like, ignore that. Just look at the flock of geese over there. Last night, in my opinion, was a big flop in terms of market maneuvering, or I'm sorry, position maneuvering. I think Trump is going to have to increasingly look towards this declaration of emergency. And as we inch towards uh, his limitation of choices and decisions, the increased likelihood of that happening uh, is evident to me. Uh, I don't know how that goes down from there, but that's pretty much my thoughts on that. And that would play more havoc, I think, with the government shutdown, and to declare an emergency for not having a wall for border security while at the same time having the government shut down. I'm not sure how that works. The point is, it increases uncertainty. So why don't we go to the markets first? Uh, and then we'll go to, actually, no, let's go to gun lock, right? We can do this pretty quickly. All right. The charts are not in any particular order uh, uh, for my display. I do have a post. Let me bring that post up again. All right. Here's the post with miniatures of the charts. All right. I threw this together last night after listening, just so I'd have some reference points. Okay. He's a big fan of the copper bond relationship. Now, what you have here is the red line is copper, the blue line is the 10-year yield. Uh, uh, he wasn't clear on how he looks at it, but I don't see copper as leading so much as converging and diverging. So if copper gets down here, um, hold on, let me see if I can here. Copper down here, uh, you would expect either copper to go up, right, or bond yields to keep going down. So I think what he's saying is when you have a divergence, like here, uh, you have a convergence, right? When you have a divergence, generally the normal behavior, especially in exacerbated moves, is they move in tandem. And when you have changes, you have divergence and convergence. And what he's saying here now is that he didn't say this, but he basically said uh, copper is telling you that yields have to continue lower, was his call as well. Uh, I would say that it also could be copper going higher. So how that happens um, is entirely up to him. But this is a big favorite of his. So why don't we just stop annotating here? All right, and good. Okay, so we got that out of the way. We got that chart out of the way. All right, let's go here. This is the meat of his point. He's a technical guy. He believes, and it may not be easy to follow on the chart, but I will explain it to you. All right. The annotation above is from Tyler at Zero Hedge, and I'll thank him for that. Basically, he's a Fibonacci guy. So if you look at the high here where my arrow is, and you look at the low here, a lot of people use these. I don't use them except for noting that other people are using them. So low to high is 100%, right? And this is 62%. So it's even though it's an inverted chart, low to high, I'm sorry, high to low is 2 steps forward or 3 steps forward, 2 steps back. And this area is 61.8, call it 62% retracement. And he noted, like any good technician who uh, finds what they want and fits it to it, that the market bounced off of that, and he believes that and I think this is a rounding top here, and he believes that the dollar is headed lower. Now, I'm not Fibonacci numbers matter to me because other people pay attention to them, and I will use them for stops, but I won't use them for entries. I'll use them for exits sometimes. The thing that I do lean heavily on when I'm looking at more macro charts, like this is a monthly chart, I believe, uh, is RSIs, and a lot of people don't use them anymore. But I was pleased to see that Gunlock does use them, and I think they're very good if you're looking at longer term macro trends. What his point was here was that, and I'll show it on this chart, but he has another chart, is when the dollar made a high here, the RSI was here. All right. All right. So now when the dollar made a high here, the RSI was here. And now we have increasing highs with on would you say lower strength or less volume. And I would attribute this to an increase because there are just less dollars out there. It doesn't negate what he's saying. But what he's saying is you're making higher highs on lesser volume, on a relative strength index. It's kind of like you made the high on lower volume here than you did on here, so it's less of a convincing trade. But let's go to the next chart where I think he makes that a little bit uh, clearer. No, that's not it. Nor is that. That's emerging markets. Okay, here's his point. His point is, again, looking at the bottom chart where the green and red um, sections are. The high here, he's looking at in a different way. He's looking at it now. This is green means longs in the dollar, and red means net shorts. So when we had this level of longs before, right, you had this high. Now we're at this level of longs, and you have this high. And he's basically saying at the same level of longs, you have um, a lower high. And this would be called, some people call this a negative divergence. If you want to think about why this exists, think about it the way the RSI is. The market's making a high in open interest, right? But it's not making a newer high. So the buyers, let's say everyone has a limited amount of money to allocate to a position, are at their limit, let's say, and they haven't gotten the market higher. So it's kind of like a non-confirmation in Dow theory. Again, he believes this augurs for a rollover lower. That's not always true, but it is a good sign that if the market starts to sell off, uh, you have your rationale for that. And that ties into gold. These are emerging markets. Basically, I'll just give you this in one line. He believes that, well, he cites that in the past, a weak dollar has been bullish for emerging markets. And that makes sense because they're more indebted to us. Um, the strong dollar is bearish for emerging markets. He believes that a weak dollar is coming, and that ties to his comment that his reiterated comment that he thinks emerging markets will converge stock-wise with the U.S. And he cites this chart at the bottom here as emerging markets coming off the lows. I think it's too early to tell, but certainly for the beginning of this year, that's been good for a week or so. Okay, quick comment on this. Core inflation, his takeaway comment was core inflation is not backing off. Now, I don't see that, um, uh, but I'm not going to, I have to look more into it. All right. Next, right. We went through both of these charts at separate occasions. So you understand that already, hopefully. All right. I think this is one of the flies in his ointment. We're watching gold rally here. The dollar is slightly off, but it hasn't moved enough to justify this kind of rally. I think the buy orders are back in. But turning our attention back to the commodity price and recessions, he's been calling for recession, and he puts up several charts that show the possibility of recession. And each one he did say, I'm not sure. He's not hemming and hawing. I'm surprised actually at how dry his presentation was, and I have a little bit more. I had respect for him before, but now I have a little bit even more respect for him because he wasn't a lunatic pounding a table. He basically cites this that these red lines are recessions, and he notes that recessions come after a peak in commodities most of the time. They don't come here, but they do come right after here. They come during here. They come during here, and they have come in a big way during here. And the reason for that is, Fed hiking, commodities are a symbol of overheating. Fed hiking, commodities drop, and you have a recession at the same time. What he's looking at here is he can't justify a recession coming from this data because commodities are off their highs already, and we're not in a recession, especially with wage growth growing. He cites many contradicting things to his opinion, one of them being wage growth is accelerating, commodity prices aren't on their highs, but he's still looking for the dollar to weaken. I can sum it up from my own perspective by simply saying this: uh, gold. I'm sorry. The S&P is not the economy. The S&P stock market will sell off at some point. We're not done this bear run yet. And when it does, at some point, call it 2000, 2100, the Fed will have to back off of QT and perhaps even go QE. When that happens, you'll see the dollar drop quickly. You'll see stocks rally across the board. You'll even see bonds rally, and you'll see gold rally too. So I think we'll be back in a QE type of mentality, but gold will rally, I think, harder because we'll have a little bit of the bad inflation that we're talking about. Now, uh, I didn't open this chart up on the. Wait a minute, where did that chart go? Here we go. Okay, I apologize. This chart is very small. Why don't I just bring it up? Well, what you're looking at here is a monthly gold chart at spot, and he draws a line, the dotted line down here, which I have drawn as well, and I'll show you that in a second. He does not draw the line from bottom up, which most people do draw. He does draw a parallel line, and this is what he says basically. Gold has performed perfectly, uh, which to me is a tell that he's long it. Uh, Meaning it bounced. This is what he says, because it bounced off of this area, and this is about the time he said to start. He was going to consider starting getting long as well in the press, and now it's moving up. Now he believes, and this is a technical comment, so you can't swear by it. But what else is there to look at in gold but the technicals, unless you're looking at miners and their fundamentals? He believes that once the dollar really starts to take off, or I'm sorry, once the dollar really starts to dump, that this line will be the line that determines a more parabolic move in gold. So that's his take on uh, the market. And why don't we do our take on the market? And we'll bring up today's numbers. And I took the trouble of starting with these numbers: 1289 and 1283.60. Those are your initial ranges. You're looking at gold spot there. If you want to look at gold futures at $1.10, so it's 1284.70. So if we break decently below 1283.60 in futures and back above decently, look for short covering to come in. So at this point, we're looking for short covering to come in, because this is about $1 above uh, where the market is. So you could get long here with a stop out um, at your choice based on how much money you want to risk, and you would look for 1289 for your first level. All right, and if it's the market breaks through 1289, you would stay longer again there. So if you're trading purely technically, which I don't, this is an upwardly sloping line he's looking at. You can be long right now with a target of 1289, and I would say a stop out of. I'll give you a stop out. Let's see, if your target's 1289, uh, that'll be 1288 on this. Your target's here, so that's $4. You should risk $2. So you 1284, 1282. So 1282, 1284. All right. So right now, futures are trading 1285. All right. You buy it at 1285, you risk $2 to 1283, and you look to take profit to 1289. That's a technical trade level I'm giving you with a 2-to-1 risk reward. I'm not going to take that trade because that's not systematic enough for me. On the highlighting area, um, he did note that we have a bull structure, but he is put us in a bull structure. We have seen 53 of this, blah blah blah. I didn't call this. However, this may now. I said this yesterday, but we're going to say it again. This may now be in a corrective phase against that bull structure from 1236. He's referring to the move from here. We'll do this to Delia from. He's referring to this base here and this trend line that comes in here. So he's looking at a trend line on a daily basis that's through this area, and he's saying that we have broken that, and we are in a corrective phase uh, that could uh, bounce hard or to 1304 or just correct a little bit lower. So right now, what he's saying is macro bull plays should be put on hold. This is what he's advising clients. Macro bull plays should be put on hold. Day trading is fine, but he wouldn't be macro bullish again unless we got above 1300.4 and stayed there. So look for longs to be selling at 1389. I mean 1289 and 1300 spot 4, and look for buyers. Look for us to reverse hard, I think, below 1283, this number here, because it's an upwardly sloping line. It's a line that will come in at a higher level today. So look at gold, what's going on now, and the dollar's doing nothing. So why is gold rallying with the dollar doing nothing? So um, okay, it could be related to Fitch's warning about the U.S. rating, and the U.S. rating is something that they have to say because we're in a government shutdown. Because we're in a government shutdown, we're not able to pay our debts. Everything is basically shut down. So I think the thing to do now would be to look for uh, the 10-year bond. So the 10-year bond is up. Uh, yeah, the 10-year bond is, there's your key. The 10-year bond yield has jumped a little bit. It's up, 17 pips, 1/10 of, almost 2/10 of a percentage point. And that is a reaction to likely the Fitch rating. And gold, more than most markets, will overreact. Uh, this is what happens during a government shutdown. People pile into gold. Uh, I'm not convinced that this is something to be excited about, but why don't I give you some trading levels for today in gold? You've seen the technical levels. I would be wary of an hourly settlement below 1282.20, which is consistent with going through his technical level of 1283.60, I think. On an hourly settlement below 1282.20, I'm going to be bearish. I'd say on a scale of 1 to 5, it would be a 3 in terms of conviction, uh, sell signal. On a daily basis, we are in a retracement. This is a bull flag, but I have nothing to give you in momentum. On a weekly basis, the market is doing what it's supposed to do. Since we got long in this area here and traded around it, we are still long on a macro basis, but that's just in a personal account, not trading, just something we put in a family money, our family funds. 529s, 401ks, et cetera, et cetera. But you will notice that we have a higher high and a higher high in the RSI, and we have a lower high. This is enough to get any gold trader very bearish. If this week settles red and even below last week's low, look for a big move lower. And I'm thinking that the market has below 1282 and change in futures. I think the market's going to go to 1276 easily, and then perhaps 1268 below that. If you're a Fibonacci guy, you would go low to high, and you would measure 2/3 from that down here, and you'll probably come in the 1/3 down here, probably be in the 1260 area. But that's pretty much it. So there's really not a lot of active trading to give, although we are, it looks like, at the precipice of either a breakout or sell off. I would be looking to short it below 1282.20 in futures, and I would be considering buying it above 1289 on an hourly close. However, I will not have a good risk reward on that trade on the hourly breakout. Yesterday we had 3 trades. None of them were in gold. 3 of them were in the S&P. One was a stone cold winner. The other was a winner that I got a little bit piggish on, and I scratched on, and the final was a loser. So on the day, I was flat, basically. One winner, one stupid scratch, and one loser. Have a good day. My name is Vince Lanci. It is 8:25. Stay with us for the AM roadmap, and be careful.